In this video, traders, we're going to look at the difference between stable and volatile currencies. Stay tuned. Hey traders, a very warm welcome to you. So many of you are FX traders out there, and many of you trade the major pairs like USD, JPY, GBP, USD, Euro USD, all that kind of stuff. However, sometimes we want to have a little foray or a little fish in different markets. We want to do some of the more volatile pairs. So what is the difference between the stable and the volatile currencies? How can we tell the difference? What kind of signifies the difference? And as traders, how can we approach them in a different manner? So stable versus volatile. Now, you're going to laugh in a minute when I mention one of the stable currencies, but this is a generalization. Generally speaking, stable currencies, the countries have a diversified goods or services, or the economies have a diversified goods services. EU is economy, low inflation, stable trade, so there's not kind of swinging around and the numbers aren't swinging back and forth and people don't know where they are, and stable government as well. So decent political system in place that regardless of what you think of the current government in whichever economy it is, it's relatively stable, i.e. they kind of don't really abuse their power so much, and it's part of the rule they're going to be in until they're voted out. So that's really the kind of major things for looking at stable currencies or stable economy. So that's going to be things like obviously US dollar, euro, pound, Japanese yen, a Norwegian krona, Swedish krona, Hong Kong dollar, and Swiss franc. And yes, I know Swiss franc, you're going to say, how is that stable when it moved 40% in a very short period of time? Unusual event. Hey, listen, this doesn't mean that these things aren't going to move, and we've seen some volatility in all of these at some time or another, but stable in terms of, generally speaking, the attributes of the chart and the way they trade in the price action is much more stable than these guys here, which are volatile. So these ones are kind of, these aren't just isn't a finite list by any means, but mainly susceptible to policy interference. So people are nervous about holding these. People are nervous about stashing cash in them as an asset, or storing any of them as a wealth storage facility, or using them as any real currency, because they don't really want the exposure to them because they can move so much. So the Brazilian real, the Russian ruble, the Mexican peso, the Argentinian peso, just to name a few. So these guys are much more volatile. You don't know what's going to happen, and that is exhibited in the price action in the chart. These do obviously from time to time exhibit some aggressive moves when we have things like Brexit, when we have all the kinds of things that each one of these has had some kind of influence on them. But generally speaking, they will exhibit general day-to-day smoothness, if we can use that word in the chart. These are a little bit more angry, a little bit more aggressive. So what have you got to do? If you're deciding to foray into these, crossing between the majors, or whether they're crossing with each other, or whatever you're doing, you need to be careful. The bigger thing to do is to use wider stops. It's going to be a bigger move. It's going to be a lot larger than you're used to. If you're used to trading 20 pips stop on this, you're going to want to trade 60 pips plus on that. And don't forget, guys, this is going to cost you a lot more to trade. The brokers will want to charge you more because they have more inherent risk. And of course, the liquidity in the underlying is less. So you're trading a larger spread. You've got to trade a wider stop. What does that mean? You've got to reduce your position size. You don't want to be trading the same size of this as you do for this, because you're going to get 3 times the move. If you get 3 times the move, what do? You're going to third your position size, if not more, because you've got an added risk of not being able to get out of it. So in terms of strategies, range bound trading, fine. You can look at fading highs, fading lows on this kind of stuff, jumping on trends, getting on board. This, you really want to be looking for the really sweet spot trades, the best trades that stand out, the stuff that you would love to take on this but don't happen very often. You wait on when these maybe come into range. So this is how I know currency traders will trade this. They will wait until these come into play, so to speak. So they're not going to trade these every day. These are their bread and butter pairs. They'll trade a variety of those. But then when something is happening in Russia, in Mexico, in Brazil, whatever it may be, they will then focus on that for a quarter or a couple of quarters of the year against one of the majors, see what's making that move, and develop a trading strategy around that. Except the thing that and spreads are going to be higher, they're going to have to use wider stops, but they're now in tune with that because this catalyst is something, and generally that's going to make it move in one direction or another aggressively. And so they'll jump on it and they'll say, okay, well, you know what, I understand the higher risks of it, but there's a decent risk reward ratio here. I don't play in this pool very, very often. There's a lot more liquidity in it now because a lot more traders are looking at it. There's a reason to get involved in it, and I'm going to harness and utilize the high volatility to my advantage and take profits from it because I'm using momentum-based strategy. I'm using kind of those stretched out strategies that then ping back. I'm being a little bit more cautious. I'm waiting for those sweet spots. So if you're going to trade currencies, guys, these are the stable ones. These are ones if you're starting out, you want to stick with. If you're kind of a bit more advanced now, you want to have a different flavor with different things, you can start to look at the more volatile currencies, being aware that you can get caught out as well. They can just spike up ridiculously on relatively low volume. So understand there's a lot more risk involved in that, which is a rarity with this, putting the Swiss franc aside. But that's what you've got to look for. Cautious the volatility, decrease the position size, watch out for the spread, watch out for obviously having a wider stop and accounting for that increased volatility. All right, guys, take care. Whatever you're trading, keep the risk managed. See you next one. Bye-bye.